Good morning and welcome to Financial Strategies with Scott Wardell. While various products may be discussed during the course of this program, please note that these discussions are intended only to educate you about financial topics. They are broad in scope and do not consider your individual personal financial situation. You should work with a qualified financial professional in collaboration with your attorney and tax advisor before implementing any financial decisions which will affect your personal financial situation. Thrivent financial representatives cannot provide legal or tax advice. Your local Thrivent representatives are Wayne Grunkley and Alan Sogstead, 215 Atlantic Avenue, Morris. Call 589-1731. And now, Financial Strategies with Scott Wardell.
Welcome into this week's edition of Financial Strategies with Scott Wardell. I'm Steph, your host, Scott, and our guest today is Adam.
Ryan.
I'm terrible at names.
Ryan Ash. Adam's the guy that
Ryan.
works with you.
Really? This whole time I've never known his name. I'm doing pretty well. How are you?
It looks like we're going to have another really, really nice
my goodness.
weekend. Boy, I tell you, we've had some nice weekends. As soon as that wind quit blowing.
Yeah, it took a long time, but then the weather turned great.
It's been just absolutely wonderful.
And why do I see wonderful fruit in front of me?
You might think these are for you, but I have a basket out in the other room for you and the rest of the staff. These are actually for our guest.
I thought you were going to give them to callers, and I'm like, it doesn't work like that, really, Scott.
We should give away the callers, but no, these are honey gold, and it's a late season apple, and I just thought it'd be fun to bring them in for you. And Ryan, thanks for joining us here today. And so we've got the special treat of the day is the honey gold apples for Ryan for joining us. Thank you.
Yeah, I appreciate it.
Thanks, Ryan.
That's how he pays me. Pretty cheap labor here today.
Well, you know what? He doesn't pay most of his guests, so consider yourself lucky.
All right. Well, thank you very much, Scott.
Our topic today is actually going to be retirement income dilemmas, talking about how long your money will last, how do you make it last. But before we get to that, Scott, we usually like to look at the past week in the market summaries, that sort of thing.
Right.
There's been big fluctuations for the past several weeks, even months, if we want to go that far back.
Right.
If people are invested in financial markets, is there anything they should do or know to help insulate themselves from some of that volatility?
Absolutely. And this is a week where the market was up over 2%, and people are feeling a lot better. The market was up last week. We started out Monday, of course, with a down day, and it looked like the market was going to give back, as it has so many times where we have a week of gain and then it gives it back, and then we gain it back, and then we give it back, and it's really been a hard market, frankly. But this week, we continued the trend, and hopefully it's a trend, and had another up week. And this is a great time. This is when people are not feeling fearful so much, when the market has a couple up weeks, but it is the exact time when they have to start evaluating their portfolios. So it's a little counterintuitive, because everybody wants to evaluate their portfolios when in fact they're down and when they're feeling threatened. And that's a very hard time to evaluate your portfolios, because there's less that you can do.
Right.
So I highly encourage people to take the time now, even though it's not knocking on their door and it's not saying, oh my gosh, I really need to do something because the market's going down. Now, folks, is the time to sit down and look at it. So first of all, always have good diversification. Do an asset allocation plan. Make sure that you are invested according to your risk, because your portfolio is likely to drift over time. It does. Just the very fluctuations are causing it to drift over time, and make sure you have that good balance. Also, examine your cash reserves. Remember the lessons from 2008. In that the people that got hit the hardest were people that did not have good cash reserves. And then, make sure, of course, that you're also looking at your income streams, because income streams, like cash reserves, help us really last through some very long and hard and dark periods of time. So why am I talking about dark periods of time? I don't really feel like the market is going to, go to pot on us. However, again, the time to really take action on your portfolio is when we are really in an up market. And really the last and probably most important thing is investigate ways to mitigate your risk. Okay, so mitigate the principal risk and still get some growth is the objective of most people. That might be rediversification. That might be taking a look at maybe going a little bit more conservative. But then again, there are other ways in which you can mitigate your risk. And you have to sit down with a financial professional to make sure that you're looking at those things And this is the time to do it. We said when we started this show we're going to do it to help people pay attention to things that are going to be really important to their financial future. And this is one of those things, and this is one of those times. Even though things look better today, and of course the reason they look better is because earnings reports are coming in. And I don't know, Ryan, if you had a chance to read any, but they look pretty positive.
Yeah. That's good news.
Good, as a matter of fact, a couple of the financial journalists are saying, boy, from a corporate standpoint, this doesn't look like a recession because corporations are making a lot of money. It's a good leading indicator because that means hopefully they're going to start to employ, some more people to advance, the employment numbers in the U.S., and that, of course, would help us get us out of this situation a little bit more. So this week there was mostly positive news on the corporate earnings. There was also, good news about the European Union and some of the steps they're taking to mitigate the risk and the problems that are going on in Greece. Those two things came together to really give the market more confidence, and there is a lot of cash on the sidelines. So when the market has confidence, there's ability to buy. So at any rate, enough about this last week. Let's get into our topic, which is retirement income dilemmas. We're going to talk about a whole bunch of dilemmas today. So if you're facing a retirement within the next, 10 years even, but especially 5 years, or if you are retired and you're saying, I'm facing these dilemmas today, stay tuned here as we walk through these answers. So
and we should mention maybe at the end of the show, Scott, we're trying a special new thing.
Yeah, absolutely. We're in the last probably 20 minutes or so, we're going to take call-in questions. If you have questions about retirement, you have questions about particular pieces of your retirement investments, maybe it's a question about long-term care, give us a call because we're going to answer some questions online today. So stay tuned for that and be ready to call when you, if you're listening here today. But I have Ryan Ash with me. Ryan's been on the show before.
Yeah,
Thanks
how are you doing, Scott?
I'm great.
Thanks for having me.
Absolutely. Love having you. Ryan's a CFP, Certified Financial Planner, and he works in the Prior Lake office. And so, Ryan, we're going to be talking about retirement planning and the dilemmas today. But as you're helping clients with their retirement plans, what do you think? What do you think, or what do you feel? What do you hear is their number one dilemma?
Yeah, I think when people come to visit our office, first question we always get is, do I have enough money to retire? And a big part of this is healthcare costs.
Yeah, you bet.
Yeah, and actually a study done in 2009 said that a couple 65 years of age would spend approximately $240,000 of their own retirement savings over the next 20 years of retirement on healthcare costs.
Wow.
Yeah, so it makes you want to eat your fruits and vegetables so you can minimize those costs, right, Scott?
Absolutely.
Thanks for the apples today, mate. The doctor way. There we go. So,
right.
But the issue with healthcare is probably not going to be getting a whole lot better as we look at politicians here who are getting together, looking at ways to trim the budget. More than likely, this is going to impact Medicare, and this is what so many people rely on for health care insurance in retirement. And so it's important to review that. The other question we oftentimes get for those who are not quite 65 and can enroll is they would like to retire, but they just aren't sure they can do it without having some type of health insurance.
Oh, I have people almost weekly say to me, I'd retire today if it wasn't for the cost of health insurance. It's a big deal.
Yeah, and there are a few options available for these people. Ultimately, you want to see get some projections of your own retirement and see the impact and estimate those costs. But for those who are on a current employer plan, if they retire today, they do have the option to continue on that plan due to COBRA, and they're allowed to continue on that plan for 18 months.
Right.
But
it's
they
a short
will
bridge, but it's still a bridge.
It's a bridge, and they will be responsible for picking up the cost for that too.
Right.
So.
Yeah, so that could get them part of the way there.
Yeah.
It depends upon the age that they actually want to retire, and oftentimes, and I'm sure you run into this as well, Ryan, where you've got clients that are either of different ages, husband and wife of different ages, or potentially one who really wants to keep working and one who really wants to retire. That's also very common. And then often they're able to just transfer their health insurance to the spouse that's still working. that's a really easy bridge if you have
Yep.
that opportunity. But then other people go out and they buy their individual
Mm-hmm.
health insurance, the same way that a self-employed person might go about doing it. So it's not a complete showstopper.
Yeah.
People think it's a bigger deal because it's an unknown to them. And exactly what you said, I've got a number of clients that did retire way before they each reached the age of 65 where they could get on a Medicare or Medicare supplement combination kind of plan. And their health insurance costs escalated substantially here in the last 5 or 6 years. And so, that cash reserve and that income flow is really, really important.
Yeah, and I mean, if you're one who still has some time before you actually retire and get on Medicare, HSAs or health savings accounts are a good way to maybe start putting money away. And they have to be coupled with a high deductible plan, but it's basically a plan that allows you to put away pre-tax dollars and have them come back to you tax-free if used for medical expenses.
Right. So part of that strategy then, let's say if I'm 4 or 5 years away from retirement, I start putting more in my HSA than I would actually need, so that when I hit that day that I want to retire, I can start taking that money out and pay those premiums.
Yeah, exactly.
Yeah. So that's, a really good way to do it. Okay, so health insurance is huge. After the basic health care, what do you look at as the other big issues that clients face, their dilemmas when planning for the retirement?
Yeah, I think another big concern is what is the plan in the event of a long-term care situation? And I think this has become more of a concern as you have people who are either near or in retirement who are now experiencing that with their own parents and are going through that dilemma of what type of care do we want to provide and how are we going to cover that cost. And I think what goes hand in hand with that as well is, how do I protect these assets that I've worked so hard to accumulate so that maybe I can leave something for my kids or charity or other beneficiaries.
Right.
So, and with that, there's really three options that you typically have to kind of address the issue of long-term care. The first is you can apply for medical assistance. That's a state-run plan, usually reserved for those with low income, also very little assets. And
you can apply for it, but you have to go through all your own money pretty much first, right?
Exactly. That's what I was going to say. If you do want to apply for that and you have assets, you're going to have to spend down those assets to pretty minimal amounts in some cases.
Right.
As little as $3,000 for an individual and $6,000 for a couple. So it's not ideal for everybody, but it is out there. Second way is just to self-insure as well. And if you've done a good job of saving and you have the assets, that is always an option, is to be able to just pay for it out of pocket.
And I tell people, if you're going to do that, let's run a couple of scenarios to see what that could potentially do to your retirement savings. Because as you're talking about, let's say, and I hope I don't contribute to a myth here, because one of the big myths is people think that long-term care planning and long-term care insurance is all about going into a nursing home. Well, it turns out that 80% of the claims today are for home health care. Home health care is the way most people are trying to go if they can. And, bless those nursing facilities for those people that get to that point where they really, really need that kind of care. That's absolutely wonderful. But so much is now home health care. And then to that point, then you got to figure out, well, gosh, let's just say that, you do need that full care in the nursing home, and let's say that it costs you somewhere between $4,500 to $6,000. I've heard reports of much more than that per year. Let's just take the $6,000. That's $72,000 in a year's time. We like to program that in, and I'm sure you do as well, to say, well, what is that going to do to your finances if you add, $72,000 on extra expense for, 2 or 3 years?
Yeah, and especially if it's a married couple and it's just one of them who's needing that care.
Exactly.
You still have the other one who needs an income to live off of. And so, as you mentioned, that can be a big concern, and you also brought up the solution of purchasing long-term care insurance policy. And while it's not right for everybody, and you should address that with your financial advisor, it can be a good solution, and it's also probably one of the better ways to actually protect your assets as well, with
Right.
the Minnesota State Partnership Plan.
Right, I'm pretty sure you can go online and find more details about the Minnesota Partnership Plan. But 4 years ago, Ryan, that got passed, and basically what it does is it sort of dovetails what the state is willing to allow you to protect in terms of your overall assets. Given whatever size of a policy you have in the total benefit. But there are many requirements. So, we'll do another show just on Minnesota Partnership and long-term care. But that is something people need to look into to make sure that the plan that they've got does, in fact, dovetail and is accepted by Minnesota Partnership.
Yeah.
The rules.
And I think, like you mentioned, Scott, the cost of care, I think a lot of people initially look at long-term care insurance, and the first thing they see is the expensive premium. And
Right.
you got to look at it in relationship to the cost as well.
Absolutely, and I think people approach this very categorically, and it's unfortunate because they feel like I got to have a policy that covers everything. And a lot of times, frankly, within your two options of either assume the risk or insure the risk, is that there is a middle ground where you can insure a part and assume part the same way you do with your homeowner's insurance when you increase your deductible to do what? Decrease your premium.
Yep.
So there's some ways that can be approached very, very effectively. So
Let's pause, if you
Okay.
wouldn't mind. When we come back, we're talking today about retirement income dilemmas. How long will your money last? How do you kind of figure that out? Emergencies, actually. Planning for those is kind of one of our next subtopics, if you will. More on financial strategies with Scott Wardell when we return.
How would your financial life improve if you changed just one thing? Avoid ATM fees, make your gifts rather than buy them, protect yourself from identity theft, save more for your family's future. The list goes on. If you heard something today on financial strategies that motivates you to change one thing in your life, Thrivent Financial for Lutherans has free tips and resources you can use to do one thing differently. Find more at thrivent.com/one thing. Think about your finances, your lifestyle, your wants versus your needs. What one thing can you change today and see the impact tomorrow? Perhaps your family will save all your change for a month and donate it to charity. Maybe you'll finally write a will. Whether you choose to start simple or take a big step, that one thing can really make a difference. If you heard something today on financial strategies that motivates you to change one thing in your financial life, Thrivent Financial for Lutherans has free tips and resources you can use to do one thing differently. Find more at thrivent.com/one thing.
Welcome back to Financial Strategies with Scott Wardell and our guest today, Ryan, not Adam. I got that one down this time. I had to study it during the break. We're talking today about retirement income dilemmas. How long will that money last? What are the sorts of things you should think about as you're working through that? And my next question, Scott, is actually, no matter how much you plan and save and whatever it may be, there are going to be things that you're not prepared for.
Absolutely.
Emergencies.
Yep.
What do your clients do? How do they know how much they should have in those emergency funds during retirement?
Well, of course, the old rule of thumb is that you should have 6 months worth of expenses. But I think if one of the many lessons we learned from 2008 is that that's probably not quite enough. So you also should have a plan of where are my emergency cash reserves. So for instance, a lot of people would consider their emergency cash reserve to be a savings account, a checking account, a money market account. Those are the classics, right? Well, all of our listeners who have any money in those three places know that there is virtually no return on those assets. So if you say, well, gosh, I'm more than happy to have more in liquid cash reserve assets, but I'm going to sacrifice my overall return by doing it, then you've got to get a little bit more creative. And there are other places where people are that they're using for cash reserves. And one of the things, Ryan, and I know that you have done this with some of our clients as well, but they're old contracts. Sometimes people have a contract, and, maybe it's 5, maybe it's 10 years old, and they have a minimum guarantee. And let's say if it were an annuity as an example, the surrender charges may, and again, it depends upon the company that issued it, may have worn off, but they might be guaranteed a 3%, a 3.5%, 4%. You have to look at the contract because it's specific to that contract. And in most cases, that's a really good spot for a cash reserve because if those surrender charges have worn off of that contract, and you have to look at yours, then you could go in and out of those things pretty freely.
Yeah. Who thought you'd be bragging about 3.5% return on your money?
Right.
When we had money market rates at about 5.5 a few years ago.
Well, and yeah, and as a matter of fact, of course, I go way back in the 80s when, there were money markets that were paying 18%, and we were back in that time saying, oh, and there's an underlying guarantee of 3.5% on this contract. You were kind of embarrassed to even say it. People kind of look, yeah, I'll never need that. Now it's a great rate.
Yeah.
So regardless of what company you may have invested with in the past, I think it's good to look at those old contracts and say, hey, is there opportunity? Now, one quick thing you got to look into if you're going to use those is a lot of companies have what's called a rolling surrender charge. So you have to see, if I put money in, does it re-trigger a new surrender charge on those dollars? Be very, very careful, because I think actually most companies do have that, but some don't. So that's one source. The other thing is, frankly, you might consider the cash value of your life insurance also as a possible cash reserve. And of course, then those traditional things that we started out talking about, that being money markets, and savings accounts, and just pure checking accounts. But yeah, I think you should probably look at more in the neighborhood. I'm not a big fan of rules of thumb, and the reason is everybody's situation is so different. So it does depend upon what kind of income stream do I have. How much insurance do I have? So if I have a high deductible on my homeowners, my car insurance, my long-term care, all of these different kinds of insurance, I had better build that into my cash reserve, because those things, how life happens all at once. And all of a sudden you're going along and you're like, whoa, I got hit with, I had to buy a new appliance, got to have a new furnace, got the deductible. Oh, these things tend to hit people all at once. So you make sure that you're planned for that.
Yeah, and if you're in retirement and you don't have an adequate emergency reserve and end up pulling from your investments, especially in a volatile time like this, you could be doing some damage to your long-term plan on your retirement as well.
That's exactly right, Ryan. And that's really one of the reasons that we really want people to have that bigger cash reserve, is to prevent that very thing from happening. So, well, let's go to the next chapter here of retirement dilemmas, and that's taxes. So, Ryan, it's a huge area of concern for retirees. When you look at the kinds of taxes that retirees are paying, what do you think? What are the things that are on their mind the most? What's their biggest dilemma?
Yeah, I think with taxes, it really comes down to how do I create an income stream for myself and minimize the amount of tax that I pay on that income stream. And, basically, where do I pull from? And really what it results in result in more potential spendable income for yourself in retirement. And I think we're all looking for more spendable income in retirement.
Absolutely.
And when you look at the three places that you can put your dollars, or really, for lack of a better word, the three buckets, usually people have their money in three different areas. One is what we call the tax later bucket, but this is the pre-tax accounts. They're growing tax deferred, but in retirement, it's going to be all taxable to you.
Like IRAs.
401ks.
403bs if you're working for a nonprofit.
Yeah,
all those retirement plans. Yeah.
Exactly, and if you're lucky enough to have a pension, typically those are all taxable to you as well. The second area is what we call the tax now, but it's really your taxable accounts. It's maybe a mutual fund or a stock or bond that's not in a retirement account, which you're going to pay taxes on the dividends or the interest that's earned each year, and that's at your ordinary income tax bracket. And then when you sell it, if you have a gain or a loss, you could pay a short-term or long-term capital gain or loss.
Right, if it was a stock or appreciated assets, and of course if you held it long enough, because you got to hold it
Exactly.
for a year. So a little bit of technical twist in that, but absolutely.
Yep. And that's a great place when you look at emergency reserve. That's typically where you're carrying those types of accounts, because they're usually the most liquid of all of those. So
that being money markets, savings, they're going to, if they produce any interest or dividends at all, which is hard to get,
Yep.
they're taxed now.
Exactly. And the last is a tax-free bucket, and basically what that is You typically fund these types of investments with after-tax dollars. They grow tax-deferred, but they're going to come back to you in retirement tax-free. And what most people think about is the Roth IRA. That's probably the most traditional.
Right.
But Scott brought up cash value life insurance. It can work that way as well. I would advise, though, before you go taking cash from your policy, that you do talk to your life insurance agent or your financial advisor.
And maybe your tax accountant as well.
Exactly, and your tax advisor. And then the third option, too, which can provide tax-exempt interest, are municipal bonds. And if you purchase a municipal bond in the state of Minnesota and you live here, the interest can also be state tax exempt as well.
Right.
So.
Those are really good options. And of course, even with the tax-exempt bonds, you got to be careful because as you're calculating possible tax on your Social Security, that the tax-exempt bond interest enters into that calculation. So I know this sounds technical for folks, but the idea here is you got to do the math or seek a financial professional that will do that math for you and make sure that your team is put together. So I don't know that there's a week that goes by where I don't have to call someone's accountant and say, okay, here's what we're planning on doing. How do you see the tax impact of this, for this particular client? Because it is really important that you got your professionals working together on these problems.
Yeah, and with tax laws changing all the time, it's hard to really, for an individual to keep up to date with that.
And then the other part of this is that, to start with, people think about the taxation for themselves. And a lot of the plans that you mentioned, Ryan, like the IRAs and the 401ks, they're taking tax deductions as they're working, as they're in a higher tax bracket, in hopes that when they're retired and in a lower tax bracket, that they can take it out, take the deduction in a high bracket, take it out, and withdraw it in a lower tax bracket. And for most people, that works pretty well. But then at some point in time, they start thinking, gosh, there's still some money in that account, and and they're 75 years old or 80 years old, and they're saying, this money's going to end up going to my kids, and many of my kids might be in a higher tax bracket than I am, so now what do? Now I'm in a low tax bracket, and my money's going to move to a higher tax bracket, so it changes the game entirely, and that's when we start talking about wealth transfer and tax planning to the next generation. So another consideration, there's a lot to navigate in here.
Sure. When it comes to the dilemma of inflation, Scott, government says, I don't know, do we listen ever?
Yeah.
The government reports a low rate of inflation, but it's still a concern, isn't it?
It's an absolute concern, and I really appreciate you bringing it up, because I will tell you this, that the retired folks that I work with and talk to are very concerned about inflation, and even though the government might be reporting 2.2 on an average rate, and often listen to what they qualify. They say, inflation minus energy or gasoline and food. Well, let me look at my budget now and think, what do I spend my money on? Energy and food. So why do they throw that out of that calculation all the time? Now, there's one that includes it, but they like to take that out. And of course, when they put it back in, it looks much more inflationary. The other thing is that when you start to really understand how the government calculates inflation, let me give you one quick example. If you were to go out, and I'm going to approximate some numbers here. If you were going to buy a television, a normal television 10 years ago, let's say it cost you $350. Now, the thing was about 2 feet deep, right? It was a great big monster, and it was about 30 inches wide, and it cost you $300. Well, the way the government tracks inflation on items like this is when there's innovation. So, for instance, today you would go and you'd buy a flat screen TV. Well, if you went back, let's say 3 or 4 years ago, a great big flat screen TV might cost you $1,300. Now, today you might be able to go and buy that flat screen TV for $850 to $1,100. So what happens is the government doesn't track the cost of television going from $350 to now $850 to $1,000. What they said is the old television stopped, and we don't track that anymore. A new television and innovation created this new model, so they're tracking it, let's say, over the last 4 or 5 years, which makes it look like the cost of television has actually gone down, because it went from $1,300 down to about $1,000. So it shows a depreciated or a disinflation on the cost of television. Well, you know what? That's not true. And so innovation really does not fit with the normal model of how the government tracks inflation. So I will tell you that there are people that do an understudy of it who will say that the real inflation rate is really much closer to 8 or 9%. That is devastating to retired folks on a fixed income, especially in a time like this when it's so hard to get a good rate on any kind of fixed investment. So this is a really, really big deal for a lot of people. So that's why we have to make sure that people are invested in a way that they can potentially keep up with inflation, because the old fixed model is not working well at all. Hasn't really ever worked that well, except for, in periods of time when we were able to get 18% in the money market. But, frankly, you got to be a lot more creative and a lot more diligent in your work and in your analysis today to make sure that folks are keeping up. Otherwise, the big question, will they run out of money? Wow, your odds are going up big time on that one if you don't have the right kind of plan.
Yeah, and good luck trying to find that tube television again these days, right?
Yeah,
Scott?
right. Yeah, in some antique store maybe someplace, or maybe, as you mentioned, Steph, maybe eBay has somebody
Yeah, there you go.
trying to sell that tube television.
You can't even hook them up anymore, probably, though.
Exactly. Okay, so enough about inflation. Ryan, let's talk a little bit about portfolio and portfolio adjustment. We've got about 1 minute to talk about that, and then we'll come back after the break with more information about some of the things you might be looking at and timing for portfolio adjustment.
Yeah, I think the market a lot of times will determine how often you actually make those adjustments to your portfolio. But oftentimes, though, we do recommend at least reviewing this on a quarterly basis. Scott mentioned this a little earlier. The one thing you don't want to do, though, is to overreact to the market, as hard as it is to not let emotion get involved in your investing. Because I've seen people who have probably had or impacted their portfolio more negatively by doing this and selling when it's at a low, buying back in when we see a good day in the market. And so if you can, try to avoid that.
Absolutely. Yep.
Let's pause.
Okay.
Is that okay with you? We have
Sounds
much
good.
more to talk about. Stick around. Financial Strategies with Scott Wardell continues next.
Nearly 3 million members look to Thrivent Financial for Lutherans to help them achieve their financial goal. Nearly 3 million people know that Thrivent Financial is committed to excellence in financial services and caring for others. Get to know Thrivent Financial and the quality of products and services they can offer you. In Minnesota, you have a host of representatives to help you with your financial needs. Contact your local Thrivent representatives Wayne Grunkley and Alan Sogstad, 215 Atlantic Avenue, Morris. Call 589-1731 or call 1-855-346-4332. Registered representatives for securities offered through Thrivent Investment Management Incorporated, member FINRA and SIPC.
Financial Strategies with Scott Wardell. Thanks for joining us for this week's show. Scott in studio and his guest Ryan in studio. My name is Steph. Every week, Scott, we have a special offer.
Absolutely.
What do you have for us this week?
Yep, we've been talking about retirement dilemmas, and one of the things I really think is a great little piece that people can get for free if they call the number. It's called Managing Your Retirement Savings to Provide a Lifetime of Income. And I think it's 12-page booklet, but it's a meaty little booklet. It's got a lot of great information inside of it, and it's a free offer. So call this number. It's a toll-free number as well, 1-855-346-4332. I'm going to give it one more time. Call this number, and we'll send this out to you. It's a voice messaging system, so you just have to leave your name and address. And also, it's helpful if you leave a phone number, because sometimes we can't really make out what the address is, and it's really helpful that we can check on it so you're not frustrated saying, why aren't they sending that to me? 1-855-346-4332. Okay.
And while we're at it, let's throw out another phone number, just because we can. 5 to 10 minutes, we're going to start taking some calls.
Yeah, let's do it in about 10 minutes.
Okay. 952-758-2571 is the phone number you'll want to call in order if you want to ask questions of Scott and Ryan today. So keep in mind, for the free offer, different phone number.
Right.
But for the questions today in studio, 952-758-2571. You can also call toll-free 888-758-2575. We'll do that starting 5 to 10 minutes or so.
Okay, that sounds good.
All right. So we left off a little bit talking about inflation. We talked a bit about adjusting portfolios and reviewing expenses. So Scott, now what can people do who are nearing retirement if they want to reduce some crazy volatility?
Well, there's several things they can do. I want to actually take it back to Ryan for just 1 minute and say, Ryan, you were talking about people adjusting their portfolio and reviewing their expenses. Say a little more about that, and I'm going to jump right in on this volatility question.
Yeah, again, it's important that your portfolio matches your risk tolerance as well.
Yep.
And due to some of the volatility, sometimes that risk tolerance changes, or because of life events as well, that risk tolerance might change. And so again, it's important when you have those life changes as well, might be a good opportunity to talk with someone about adjusting your portfolio. And with this type of volatile market, really your best defense is to create a well-diversified portfolio and to practice good asset allocation strategies.
Absolutely. And then as we're talking about the nearing, Steph, you were talking about this whole market volatility piece.
Yeah.
Putting defense in your portfolio is the key, but you have to have balance and growth. You can't just say, okay, I'm safe, but I'm not growing. So how do we get those things together? And I really want to create a picture in people's minds here today, because if you were to have 3 major buckets for your money, okay, so your first bucket, and this is the size of that pail in your laundry room. Okay, that's your cash reserve bucket, and you want that cash reserve bucket filled up so that you can draw on it whenever you need. Okay, then the next one, which is more the size of the water heater that is in your basement, that's going to be your income bucket, and that's where you're going to draw the money off of for your regular income to supplement your Social Security, to supplement any pensions that you have. And that's, of course, going to be changing in size dependent upon its usage. I know people that actually have 2 water heaters in their home because they have big families. It's going to change in size, okay? Then the next one for most people, and this is the growth bucket, okay, this is your water tower. This is where, you're going to have a lot of your money, except for potentially when you're maybe 90, 95. So that one's going to get smaller over time. So the water tower has got to feed into the water heater, okay, has got to eventually feed into the cash reserve bucket. And so we map this out for folks so that they can say, well, how much do I have now? For most people, that water tower, that great big bucket of growth investments that they have, for most of them it has to be divided into 2 subcategories, and that's growth and protected growth, because a lot of people can't have all of their growth in an unprotected spot. It depends upon how much income and other things they have from other sources. So, as they're seeing these different size of buckets, I hope that they understand you have to manage the cash reserves, you have to manage the income bucket and make sure that it is filled up and at the right size, and you have to manage that growth bucket. And to what you said here just a moment ago, Ryan, you got to make sure that that growth bucket is matched with your particular risk. And the whole system that I just described has to be matched with your usage. Your usage being, what are my expenses? Do I have enough coming in that matches out all those daily expenses? Because when you are retired, cash is king. Okay, so and Ryan, let's talk a little bit about Social Security benefits. I just touched on a minute. How do you incorporate Social Security benefits in a retirement plan for your clients? What process do you use?
Yeah, when we look at Social Security benefits, we really think of that as for people who are in retirement, because I know I'll get a lot of laughs for maybe a younger crowd who might be listening to this, but for people who are in retirement, it's kind of that guaranteed source of income for them. It's a foundational piece that typically goes along with a pension if you have that. But usually for most people, there's a gap between that Social Security and what their desired income is. And so going back to what Scott said, that's really where then you need to be strategic and be smart about how to fill that gap up to ensure that your assets are going to last. The question we often get too is just from a tax standpoint, going back to that, how is Social Security treated? And Social Security is tax-free unless you earn a certain amount of income. And so, again, looking to consult with the tax advisor to see if some of the decisions that you make are going to impact the taxability of your Social Security as well, is usually a wise thing to do.
Fantastic. And Ryan, we're going to open this up for callers, so we're going to keep talking about our retirement income dilemmas. But if callers want to call in and ask questions about their retirement picture, if they want to ask questions about, the retirement distributions, if they want to ask, any questions about any topic, long-term care, Social Security that we've talked about today, now would be the time. And Steph, will you give them that number one
I
more
would be
time?
happy to. 952-758-2571 is the phone number to call if you want to ask a question of Scott and Ryan today. You can also call toll-free 888-758-2575. Those are our local phone numbers here.
Okay. And so we're continuing here, and we're, Ryan, as you're doing this retirement planning for folks, and you and I have a very similar process, but when do you involve family members?
Usually we try to get them involved as early as possible, in getting the proper documents in place, which, again, as Scott mentioned, that team, this usually involves an attorney or a legal professional, but it's getting the power of attorney document paperwork taken care of, healthcare directive paperwork as well, to make sure that if something were to happen to you, that there's somebody else who can make those decisions on your behalf. Someone you trust. That's a pretty important piece of that as well.
Right. So the executor of your state, you might want to be involved in. Now, it sounds like right now we're not really talking about retirement planning, that we're talking more about estate planning, but the two are so closely related, and they dovetail together so much that I think it's really important that people start to talk about that. We've all seen this bumper sticker, usually on the back of an RV, that says, "I'm spending my kids' inheritance," right? Well, folks, if you want to do that, you probably should talk to the kids because I think they're going to be okay with it. And as a matter of fact, the number one thing when we involve family members in that discussion with mom and dad, the number one thing the kids say is, "Spend it, Mom. Spend it, Dad. You didn't save it for us." And mom and dad will say, "Well, yeah, actually we did." But, the point of it is that this is the time when they could travel and do different things, and most kids are not sitting there relying on it. However, if you are on that path, and if you are starting to, spend some of that money, and you have different accounts that are set up, it is wonderful if the kids know the basic financial architecture of this. Why did you do this? Mm-hmm. One of the things you talked about earlier, Ryan, is how to use some of these different accounts for the tax never bucket. Well, oftentimes people, as they're approaching retirement or even in retirement, might take out a life insurance contract so that they get that tax-free benefit passed on to their heirs. And oftentimes the kids are like, "Why are you buying life insurance when you're 70 years old? Why are you doing that?" Well, without them seeing that overall architecture, it's going to really befuddle them. So it's really good to bring them in and have them ask the questions at the time that it's being considered.
Sure. Now, we do have our first caller, Scott. You want to take that now?
Absolutely.
All right. We have Tom on line 1. Hello, Tom.
Hi, hello.
Hi, Tom. What's your question?
Well, I'm in my mid-50s, and I've seen my parents go through a long-term care situation where their funds have pretty much been wiped out. And I'm just wondering, I'm in my mid-50s, at what point do I start looking at long-term care insurance, and is there different types? I've seen the type where you continually pay, and if you don't use it, you kind of lose the money you put in.
Right. That's a great question, Tom. We talk in the industry about there being a bit of a sweet spot for long-term care. And I'm going to share my bias with you about when you should go about doing that, because I mentioned earlier that people tend to approach long-term care categorically, and they buy actually very large policies. Here's one way you can hedge your bet. I personally bought my own long-term care policy with my wife when I was 51 years old. Now, the idea on that is the premiums that I'm paying are substantially lower than I would have had to pay if I waited until I got a little older. Now, having said that, you don't have to buy the whole deal at once. Most people, as an example, if you look at your life insurance contract, as things go on in your life, you might add on different kinds of life insurance as things happen. Well, with long-term care, you want to make sure in the same fashion that you got that base coverage in place. And I think it's really good to get that base coverage in place in your 50s. And then if you decide, you know what, we really need to add on, you can oftentimes do it. Now, there's always underwriting, so you got to be in good health. oftentimes do it with the same policy, or you take out a second policy, but you put two thin policies and you layer this. Now, this is Scott's strategy because a lot of people in the industry will have you buy, that whole big thing at the first case, but that will help protect those costs and hopefully help protect your estate. The other piece of your question is, gosh, you pay these premiums, and what happens if you never use it? Well, here's there's a lot of companies that now have a combined product. And the combined product says that if you don't use it, here's the money that gets paid to your heirs because it's got a component of life insurance, so it actually gets paid in most cases in a tax-free way. And there are other combined products where they combine them with annuities and there's cash value and other possibilities exist. So it is about sitting down with your financial professional and finding out those things. That's a great question, Tom, and I really appreciate it. That one was on long-term care.
Thank you very much.
You bet. Okay, so Ryan, as we're going forward here, let's take a look. We've been talking about these retirement dilemmas. What are the most common mistakes people make when looking into planning for retirement? And by the way, if people want to continue to call in with more questions, we'd be delighted. And Steph, will you give that number one more time?
Yes, 952-758-257. We should make magnets, financial strategies magnets that have all the phone numbers on them.
There you go.
952-758-2571. Toll free is 888-758-2575.
So call in if you have other questions about any retirement dilemma. But in the meantime, Ryan, most common mistakes people make when looking into planning their retirement.
Yeah, Scott, I think the first mistake that a lot of people try to do is they try to do it on their own. And I've met, just this last week, I met with two clients who are within the next year or so looking to retire, and the statement that they made to me is, I don't know how we would do this alone with the market volatility. It was something that maybe was a little easier to do in the mid-90s, maybe even mid-2000s, where the market just continued to go up, and it wasn't necessarily whether or not your account was going to go up, but by how much. So that's one. I think the second is just underestimating the cost, and we talked a little bit about health care.
Right.
And the third is just not having a solid distribution strategy that addresses these concerns of market volatility, impact of inflation over time on your portfolio, and then the third part, which you've spent a lot of time talking about, but that contingency plan or planning for the unexpected events in retirement.
Absolutely. We always say that one of the purposes of our role with clients is to turn hopefully into predictably, and that's what you're talking about, and having this distribution strategy or plan in place. Don't be just guessing at it. Figure out what it's going to be. Exactly. Okay.
Let's pause for a moment.
Yep.
We'll come back with a little more, start to wrap up financial strategies today, and we will continue to take your phone calls if you have questions. 952-758-2571 or 888-758-2575.
How would your financial life improve if you changed just one thing? Avoid ATM fees, make your gifts rather than buy them, protect yourself from identity theft, save more for your family's future. The list goes on. If you heard something today on financial strategies that motivates you to change one thing in your life, Thrivent Financial for Lutherans has free tips and resources you can use to do one thing differently. Find more at thrivent.com/one thing. Think about your finances, your lifestyle, your wants versus your needs. What one thing can you change today and see the impact tomorrow? Perhaps your family will save all your change for a month and donate it to charity. Maybe you'll finally write a will. Whether you choose to start simple or take a big step, that one thing can really make a difference. If you heard something today on financial strategies that motivates you to change one thing in your financial life, Thrivent Financial for Lutherans has free tips and resources you can use to do one thing differently. Find more at thrivent.com/one thing.
Welcome back to our last portion of this week's Financial Strategies with Scott Wardell. I'm Steph. Our guest in studio this week is Ryan, and we're talking a little bit about dilemmas that you face as you reach retirement, actually backing up a little bit and continuing to talk about mistakes people make.
Yep, and Ryan, you were starting down this path of the most common mistakes people make when looking into their retirement plan, and you said trying to do it alone. And that is, as you're saying, that's maybe a husband and wife over the kitchen table trying to get this figured out. So who all, when you set somebody out to say, we're going to get a fully fleshed retirement plan, who all should they consult to get all these pieces together?
Yeah, and there's kind of been a theme here, Scott, in that it is a team effort. Really, the people that I consider on my team oftentimes are a financial advisor. Also, health insurance is such an important piece of this, so oftentimes we're working with a health insurance broker, somebody who's appointed with several different companies too, so that they can give you a variety and search the best plan to meet your needs. We've mentioned a tax advisor. They're almost always included in this process as so much of retirement is dependent upon taxes.
Right.
And the third, again, when you start to get into some of that estate planning, is making sure that you have someone who's a legal professional, an attorney in the area.
And, on that tax issue, one of the things that I know I've encountered with many clients over the last year is that they might be facing a fairly low income year. I've got, some clients where one spouse or the other is, frankly, not yet reemployed. And some of them have run out of their, unemployment kind of benefits. And oftentimes the family's still doing okay. Sometimes they're not, but oftentimes they're doing okay. And so we take a look at a tax situation where they're maybe paying substantially less in taxes, and we try and turn the lemons into lemonade. So that might be, and I'm just saying might, because you always have to consult your tax advisor, that might be a time to do a bit of a conversion, as an example. So the conversion being from your regular IRAs or from a 401k into a Roth. So take that tax later dollars, as you were talking about earlier, get them over into the tax never bucket, and really build up. Because for most people, that's the part of the portfolio that is the smallest. If you think of those three areas that Ryan talked about, the tax now, tax later, tax never tends to be the smallest for most people. So we really want to, try and help them shore that up if possible. And we'll be delighted to take more calls if our listeners want to, put some courage in those fingers and dial us up, because
Sure.
we've got Ryan here. He's a CFP, and I'm here, and we're going to try and answer any question you field towards us.
Yeah, 952-758-2571 or 888-758-2575 if you have questions today.
Okay, so let's, Ryan, just chat just a little bit more about this market volatility piece, because, again, our listeners have seen, their investments, many of them, I would say, recover unless they, rushed into cash when the market was really low. Then they didn't get much recovery at all. But from the low in March of 2009, they've seen some pretty nice recoveries now. Now we see some volatility where I think in some weeks they're saying, wow, what do I do now? I feel like it's recovered, and now I look at my statement and it's going down again. So talk about what some of the strategies that you would advise that they might employ to really mitigate some of that risk.
Yeah, again, this is all very tailored to an individual's needs. So,
Absolutely.
We're stating some pretty general ideas, but one example, and you touched on it a little bit, is investing using a vehicle that allows you to protect your growth as well. And there are different living benefits now that are attached to annuity products, and some of which allow you to still remain invested in the market, but you're able to protect all your original investment. And there is a cost to this. It is basically like putting insurance around your money. But this is a strategy for people who are maybe more conservative. They don't want to give back the growth that they've seen here, but yet they are concerned about the long term of their retirement plan and making sure they have money at age 90.
Yeah, and when you say that, of course, there are so many iterations in the marketplace of protection things that are on different kinds of investments. You mentioned annuities. So you really have to go in and read both the fine print, all the disclaimers, and dig into what those costs are and how solid, frankly, is that guarantee. So, for instance, I was reviewing a contract for somebody here, it's been about a year ago, and they did have some guarantees in their annuity contract. This was for a company. It wasn't our company. It was another company, and we do this when we do a full financial review for people. We get down into all their contracts, and it turns out that there was a provision in the contract that the company, at its will, could take and put the money out of stocks and into the bond portfolio. Well, this struck me as awfully odd, because the whole idea that they're trying to do is maintain a growth strategy, at the same time as they were trying to get some protection. And so this particular company said, well, you know, if certain circumstances happen, we can put it in the bond portfolio. And that's exactly what the company did. And so, I mean, it doesn't take a lot of in-depth analysis to realize the company wasn't really protecting the client. The client had the guarantee. Mm-hmm. They were protecting their own interest to say, gosh, if the market's going down, we're going to take a more conservative position so that if we have to come up with this cash, we can come up with the cash. Mm-hmm. But what it did is it diminished the client's growth potential substantially. So just one little example, but it is some of the things you have to look into when you are looking at mitigating the risk is, well, okay, yeah, you're going to give me a guarantee, but what goes along with that guarantee? Because some companies have a much, you know, I would say a pure formula for how they manage that along the way.
Yeah, and what are the costs associated with that as well? You know, in our review as well, there are some pretty great guarantees. They sound very good. When you start to dig into the overall cost, then they don't start to look so good. And so as Scott mentioned, it's important that you do review this and really take the time to understand it.
Absolutely.
Very quickly as we wrap up, Scott, every week you want people to pay attention, to listen, but what are your main goals this week? What do you hope our listeners took home?
Well, we really hope that we're starting to form a checklist for them, and the checklist would include look at your health insurance, look at the possibility of managing your long-term care risk, figure out what your pensions and Social Security are going to provide for you on retirement, and look at the IRAs, 401ks, and look at the investment balance, and don't do it without a plan.
It's a big week next week. Scott, what do we have coming out?
We have Russ Swanson coming up. He's the Chief Investment Officer. He manages over $75 billion. But I also want to encourage people to give us a call if they're interested in attending any of our seminars. Ryan and I together are giving a seminar October 27th and November 1st at Fong's Restaurant in Prior Lake. So if people want to come in and ask more questions, this would be the time to do it, and call that same number. Thanks.
We got to wrap it up. We'll see you next week on Financial Strategies with Scott Wardell.
We hope you've enjoyed the past hour of Financial Strategies with Scott Wardell. While various products may be discussed during the course of this program, please note that these discussions are intended only to educate you about financial topics. They are broad in scope and do not consider your individual personal financial situation. You should work with a qualified financial professional in collaboration with your attorney and tax advisor before implementing any financial decisions which will affect your personal financial situation. Thrivent financial representatives cannot provide legal or tax advice. Your local Thrivent representatives are Wayne Grunkley and Alan Sogstead, 215 Atlantic Avenue, Morris. Call 589-1731. Join us again next week for Financial Strategies with Scott Wardell on KMRS Morris.